time, your taxes go way down. They go hand in hand.
Interesting.
Okay, being conservative is not a matter of paying more tax. Being conservative is a matter of understanding the law.
Interesting. So looking at maybe some of the poking that President Obama did last week, stating that that the IRS code is inefficient, and a lot of business owners, because of their attorneys, because of their tax advisors, aren't paying any tax. What's your opinion about that?
Well, I just have to laugh, because if they're not paying any tax, it's because Congress doesn't want them to pay it.
Yeah.
Okay, so if you want to pay tax, change the law. If you don't want entrepreneurs to put their money back into their business, then change the law so that you don't get deductions for your business expenses. If you don't want investors to build housing for people, then take out the tax benefits for real estate investors. If that's really what you want to do. What I think, though, is that it's a bunch of rhetoric, saying, okay, well, you people who are employees, you're getting the raw deal, and the entrepreneurs are really, they're not paying their fair share. Well, that's baloney. That's absolutely baloney. The entrepreneurs are doing exactly what Congress tells them to do. Yeah. So, who's more patriotic? The one who does what Congress tells them to do, one who doesn't. Yep,
that's a very good point. And there's just such a negative connotation out there about those that are making a lot of money. But again, going back to our original train of conversation, it's those business owners and entrepreneurs that are creating the things that are making life so efficient these days. So maybe
it's not just that, Patrick. It's that the reason for these tax benefits is because you want to encourage those entrepreneurs to produce. Think about who pays the least amount of tax. It's the producers, investors, and entrepreneurs. They are the producers. Employees and self-employed individuals tend to be the consumers.
Yep.
Well, do we want to encourage production or consumption? That's the fundamental question.
No, and that was a lot of my point, because today it's just people don't acknowledge those business owners or those producers, as you put it. They're creating the things that are driving the economy. It's almost an envious perspective that the majority of America has toward these wealthy individuals. And I think that going along with the rhetoric that we heard last week was basically alluding to that, when Obama stated that these big business owners and entrepreneurs are not paying any taxes.
Yeah, but I have to laugh, though. I mean, Obama's the one who just extended the Bush tax cuts, and actually didn't just extend them; he increased them.
Yeah.
He proposed and agreed to a law, for example, on estate tax that virtually exempts 99.9% of people from the estate tax.
Yep.
And so, it's just, like I said, it's just rhetoric.
Yep. Well, maybe kind of getting into because the majority of our listeners are real estate investors, entrepreneurs, and obviously are agreeing with a lot of what we're saying right now in our perspective. But maybe getting into the details of things. I mean, as you meet with your clients and talk to them about the proper entity structure, maybe talk about that a little bit, because obviously, from what I've heard, there are a lot more IRS employees that are looking more into subchapter S corporations, and auditing them more, I guess, is what the objective there was. But maybe talk about what the best setup is for business owners to take advantage of the majority of these different statutes that are encouraging us to reinvest and obviously drive the economy.
Yeah. It is interesting. The IRS, there's been about a fourfold increase in audits over the last few years, and they are auditing. They're doing more audits of S corporations. They're also doing more audits of partnerships. We're finding.
Okay.
And even then, there's still far fewer audits of S corporations and partnerships than there are sole proprietorships.
Interesting.
So people who have not used an entity and recording their self-employment, their business on Schedule C, they're still have the highest risk of being audited by 4 or 5 times somebody who's using an entity like a partnership or an S corporation.
Okay.
What I find, we look at taxes and tax planning quite differently than we used to, and the way the typical tax advisor does. We're very strategic. We think we ought to build with our clients a long-term plan of action that will permanently reduce their taxes. And the taxes and how much you pay in taxes is totally dependent on your facts and circumstances.
Okay.
So we like to say, if you want to change your tax, change your facts. So one of the key factors, or one of the key facts, is what entity are you using? And I'll just throw out a little warning to everybody who's listening that there is not one right entity and one wrong entity. There's not even one best entity. What entity is best is what's best for you. That's why when you're talking to a tax advisor, you need to be listening not for what answers they give you, but for what questions they ask you. Not for what answers they give you, but what questions they ask you. And the reason is that the more questions and the better the questions that they're asking, the better they're going to get a handle on your facts, and then the better they're going to be able to develop that strategy and determine the best entity. I mean, I hear people all the time say, well, if you're a business, you should be an S-Corp, or if you're in real estate, you should be an LLC and taxed as a partnership. And that's not always the case. I mean, for example, if you're fixing and flipping properties and you're an LLC taxed as a partnership, you're going to get hammered with taxes. Absolutely hammered.
It's a self-employment tax.
On the other hand, if you're a real estate investor, long-term buy and hold real estate investor, and you put your property into a corporation, either S or a C corporation, you're going to be paying, likelihood is you're going to be paying taxes in a year when you don't have any money. And so there's really bad advice out there, and I see it every single day. It's bad when it comes to your entity. So the key is find an advisor who will actually teach you about the entities, who will educate you. Most advisors have this idea that if they tell you what they know, then you won't need them.
I think there's kind of there's a stigma out there just about CPAs, about advisors, that there's an expense associated with it, where you have to pay more money to do the returns of each LLC. But do you see, or do you find that what individuals are not paying is costing them actually more money?
Well, that's the thing. It doesn't matter how much the question is not how much does your CPA charge you. The question is how much does your CPA cost you.
Yeah, that's good.
Okay, and it's like I was teaching a class for Rich Dad over the weekend in Houston on tax and asset protection, and one of the students saying, well, I really like what you're saying. I really like my CPA. And I'm going, well, how much do you like your CPA? Do you like them enough to give them a $20,000 raise? Because that's effectively what you're doing when you use a CPA who doesn't understand tax law and can't make use of all its provisions and isn't asking the right questions. You're giving they're costing you an extra $20,000 or more, okay, because of their lack of education. And so, if you're willing to pay that and you like them that much, go for it. But remember that that's what you're doing. Just open your eyes.
Got it. Now, one of the things that you emphasize quite a bit is not necessarily mitigating your your tax liability or proper tax planning, but it's also how to teach a business owner how to build their wealth. So obviously, operate their business, make sure their business is efficient and productive, and so forth. But on top of that, continue to build their wealth on the side.
Well, no question. And taxes are your single biggest expense. So it makes sense that if you're looking at taxes, you need to look at what are you going to do with that money. When you reduce your taxes, what are you going to do with it? And I give you a simple example. If you use your own money and you invest without tax benefits, and you invest 10%, over 7 years, you're going to about double your money. So I like to say 2 + 2 = 4. Okay? If you add debt, and to the extent we have real estate investors on the line, then they understand that is what makes real estate a good investment. I mean, real estate without debt is a pretty average to poor investment. And so you add debt to it, it's like you just doubled your money, because you go from 2 plus 2 equals 4 to 2 plus 2 equals 8. But when you add the tax benefits, and you really get the tax benefits, when you go from 2 plus 2 equals 8 to 2 plus 2 equals 16,
Yep.
That's how important the taxes are. So, yeah, absolutely. It's not just a matter of reducing your taxes. That's step one. Step two is, let's take those taxes, let's leverage them, put them back into your wealth, and let's build considerable wealth in a very short period of time.
So it's probably, I mean, and I'm hoping that a lot of individuals will agree with this, but it sounds like, as far as from a tax perspective, you're not very fond of traditional qualified plan vehicles that allow you to get some sort of tax benefit up front. You're more toward more of a residual tax savings, and obviously using that in conjunction with long-term wealth.
What I am, Patrick, is I'm a let's reduce our taxes now and never have to pay them back.
Yeah.
Okay. I don't want to wait to reduce my taxes till later, and I don't want to pay my taxes back later. Here, and you have hit my hot button here.
It sounds like
qualified plans, 401ks are absolutely the worst thing you could ever do with your money, even if your employer matches your money. Okay. And I can prove that all day long with the numbers. 401ks are just a horrible way to invest your money. Horrible. IRAs are probably 100 times better than 401ks, and they're still terrible. Okay, with the possible exception of the Roth IRA. But even the Roth IRA is only good for certain types of investing. Because one of your challenges with qualified plans, and that includes profit sharing plans and pension plans, is that you can't borrow. You can't use debt and leverage. Well, if you're a real estate investor, I get real estate investors asking me all the time, how do I invest in real estate through my IRA? And I'm going, why would you? Why would you ever do that? Because you've lost, banks don't lend to IRAs.
Nope.
Okay, so why would you give up the most important aspect of real estate is debt?
Leverage, yep.
It's everything. I mean, like I said, real estate's just not a great investment without debt. So now what you're doing, you're turning a great investment into an average or poor investment by putting it into your IRA, because you'll lose all the leverage. Not only that, you'll lose all the tax benefits. Real estate, typically, from a tax standpoint, will actually reduce the taxes you pay on your other income. So you've got huge tax benefits. You give them all up when you put it into an IRA, because when you pull that money out of that IRA, you're going to be taxed at ordinary income rates. And even in a Roth IRA, you don't get the tax benefits, the losses to offset your other income. So I'm a fan of Roth IRAs when the investment strategy is such that you're investing your money. So if you're buying gold and silver, Roth IRAs are a great place to buy gold and silver. If you're doing hard money lending or you're doing tax liens, great, absolutely, go for the Roth IRA, because there's no leverage in those. But if you're doing traditional real estate investing, you're doing the business, stay away from the IRA, stay from qualified plans. Just get good tax advice. And on a
side note, obviously, the 401k is a statute. Same thing with the Roth provisions, and those are subject to change. And in the future, if you look at just the need of our government for money to keep up with their programs, one of the only assets left that they can have their hands on is going to be these qualified plans.
Yeah. I'll be honest. I'm not overly concerned about that. Okay. The bigger concern is I'm really not getting a lot in the way of tax benefits. Okay, so let's go back to our 5,800 pages real quick. Of that 5,800 pages, about 30 pages actually raises revenue. Okay, that's it.
Okay.
The rest of it's to reduce your tax. Of that 5,770 pages, only 400 pages even deals with qualified plans. Okay? The rest of it all deals with permanent solutions to your tax liability. So here's the thing. Most tax advisors are focused on this 400 pages. Why? Because it's easy. That's the only reason. It's easy. Okay? Whereas the other 5,370 pages, you actually have to, that's where the rubber meets the road. That's where you can really get huge tax savings. And those tax savings, you never have to pay them back. So why would you ignore 5,370 pages in favor of 400 pages that really are intended for employees and self-employed individuals? They're not intended for business owners and investors.